You're listening to the Real Estate Proverbs Podcast with host Kevin Jefferson. This is the #1 podcast for African American real estate professionals who are doing extraordinary things. It's time to tune in. And now, your host, the People's Lender, Kevin Jefferson.
Welcome to Real Estate Proverbs Podcast. I'm your host, Kevin Jefferson, and today the topic is 5 things a real estate agent should know about the mortgage process. First thing is pre-qualification versus pre-approval. A pre-qualification is basically someone calling in, giving their information. The lender may pull credit, and take a look to see if they actually have the scores. But in terms of, pay stubs, bank statements, tax returns, W-2s, or getting documentation to verify that the person makes the money they make, they work where they work, that typically is not done in a pre-qualification stage. They may go over the information in terms of what type of loan types are possible for that person, but it's just a quick and easy way to appease a client and get their information and see what they could potentially be approved for or qualify for. So those really aren't worth the paper they're written on because there's no validity in the information that the borrower gave. The income that they could use could be higher or could potentially be lower, or you may not be able to use that income at all. So pre-qualification is not as strong as a pre-approval. A pre-approval is where that same person calls in. I ask a series of questions, and then as I ask those questions, I take notes to make sure it's good for them to go to the next stage. So in terms of the next stage would be to send them a link to an online application. With the online application, that allows for me or the lender to pull credit and ask for a set of documents that help verify and add some validity to the person's scores as well as their debt to income. The items that it would ask for would be 30 days of pay stubs, last 2 years of W-2s, last 2 months of bank statements, all pages, driver's license, social security card, and or a passport. In some cases, some lenders require 2 years of tax returns, all pages and all schedules. By getting those documents and pulling credit on that particular person, that allows for us to take a thorough look at how much they can actually afford, as well as how much or what they can afford. We look at the pay stubs to make sure the person's still working on a job. We look at the pay stubs to get an average of the income that we can use to qualify that person. We look at the bank statements to ensure that the person has the money for down payment and or closing costs. We look at the tax returns to make sure they don't have any IRS debt. If so, that has to be calculated into the debt to income ratio, commonly known as DTI. We look at the driver's license and social security to make sure the person submitting the documents is the actual person that's applying for the loan. Once we've done that, after we've done that formula, we run it through something called AUS, which is automated underwriting system, and it spits back the feedback. Once we can get that person approved, then we give the borrower a call, go over the options with the programs that they're able to qualify for, and we issue a pre-approval letter to that borrower and their realtor. So that, pre-approval is way stronger than a pre-qualification. Number 2 is closing costs. Common mistake is closing cost is not a percentage of the sales price. Closing cost in Georgia could be higher than Delaware. It could be less than Delaware, depending upon if the person in Delaware is a first-time home buyer or not. So closing costs is not a percentage of the sales price. Now that we're talking about closing costs, I think a realtor should know that closing costs, the percentage of closing costs the seller can give for each product is different. So with FHA as well as USDA loans, the seller can contribute up to 6% of the sales price. On a VA loan, the seller can contribute up to 4% of the sales price. On the conventional loans, there's two different rules. So on the first, if the borrower puts less than 10% down on a conventional loan, the seller can contribute up to 3% of the sales price. If the borrower puts down 10% or more, the seller is allowed to contribute up to 6% of the sales price. So just to give you a hint, if the sales price is $200,000, the seller is allowed to give up to $12,000 to the borrower. If the sales price is $100,000 on a VA loan, they are allowed to give up to 4%, which on a $100,000 loan is $4,000. So the percentage that the seller gets varies from loan to loan, and you definitely want to check with your lender partner to make sure that that you know those percentages. But I think that is something very important that a realtor should know when writing an offer for their client if they're in a position to request closing cost assistance. Number 4 is appraisals. So a common mistake is that although the lender does order appraisals back in 2008 to 2010, they changed the way that appraisals are ordered. Now appraisals are sent out to a system. In some cases, it's a appraisal management company who's a third party. They put out the appraisal for 123 Main Street, your city, your state, and someone responds to that appraisal request and they say, I can do it on XYZ date for XYZ amount. Once that happens, us as the lender, we don't know who the appraiser is. We just know that the assignment has been accepted. Once the assignment has been accepted, that appraiser reaches out to the listing agent or the point of contact if it's a for sale by owner, and they gain access to the property. They do the appraisal. 9 times out of 10, us as the loan officer, we don't know who the appraiser is until the appraisal comes back. So once the appraisal comes back, we see who the appraiser is. If there's anything that needs to be done, any refutes or rebuttals in an appraisal or any repairs that need to be done, those things are either submitted through the listing agent who sends the rebuttal to the third-party management company, or if there's a repair that need to be done and has been completed, then we request a reinspection, but that's also done through the third-party management system. So we have no contact and we don't talk to appraisers. I haven't talked to appraisers in years unless it's someone that I knew. The next thing is number 5. Number 5 is important. Interest rates. Interest rates vary from company to company depending on their appetite of, what the interest rates are. And it doesn't matter typically if the person has a great score or not in terms of what the company offers, right? So for instance, when people get rates online saying that this company offers a 3.75%, however, you may not be looking at the fine line that says the person needs a 740 credit score as well as 20% down. The other thing that's a misconception by our rules through RESPA, we are not allowed to quote interest rates. We cannot just quote interest rates because it may be wrong. Each person is different. We don't know the loan type. We don't know their credit score. We don't know how much they're putting down. And interest rates could change from 12 o'clock that afternoon to 5 o'clock that evening, and we don't know. So as a lender, we should not be quoting interest rates. Hopefully you find these 5 tips helpful. I'll recap them. Number 1 was pre-qualification versus pre-approval. Number 2 was closing cost is not a percentage. Number 3 is the percentage allowed for seller's assistance for the different loan programs on closing costs. Number 4 is appraisals. We do not know who the appraisers are, and we don't know who the appraisers are until we get the appraisal back. And number 5, interest rates. We are not able to quote interest rates, and interest rates vary from company to company. And that's something that you really shouldn't quote unless you have a full package. I could tell you anything and you could believe me, but I'd rather give you a factual information based on what I've seen at the time. Thank you. This has been the Real Estate Proverbs Podcast. I'm your host, Kevin Jefferson. Have a great day.
Thank you for watching the Real Estate Proverbs Podcast with Kevin Jefferson. Make sure you like this video and subscribe to the channel so you can be notified when the latest video drops.